Hello, I'm David Frazier, President and Chief Market Strategist of Frazier Mayer Research LLC, the providers of Investors Monitor, investorsmonitor.com, and our individual investor service, Frazier's Strategic Allocator. We're recording this week's weekly Market Insights show on Tuesday, December 13th at around 1:30 in the afternoon. As I think all of you know, we generally record these shows on a Friday or Saturday of every week, but this past week I did not record a show over the weekend because I really wanted to wait and see how stocks traded on Monday of this week and on Tuesday morning of this week, primarily because after doing some even more very in-depth analysis, not just of economic and geopolitical and corporate earnings releases, but also an even closer review and analysis of the recent trading action, primarily in the U.S. stock market, as well as other markets around the world. Because I wanted to take a closer look at that, I decided to delay our regular weekly show this past weekend and to wait until today on Tuesday. And sure enough, I think we're seeing what I wrote about last Friday and Saturday, and that is that it looks like we are having some rotation out of some of the stocks that were the better performers over the past few weeks and into stocks that did not garner as much attention and did not rise as sharply in a very short period of time. And so I feel really good about my recommendation to advise our clients and subscribers to allocate some of their money this past Monday morning to energy stocks and directly to energy stocks via the oil and gas ETNs that I recommended, symbols AMJ and MLPI, as well as for our speculative portfolio, a leveraged oil ETF, symbols UCO, the ProShares Ultra ETF in the energy sector. And I also feel good about my recommendation to advise our clients and subscribers to allocate some of their money to the medical device ETF that I recommended, IHI. And if any of you listening to this, watching and listening to this weekly internet TV show have not yet purchased or allocated any of your money to those ETFs and ETNs, I don't think it's too late to do so. You know, on my trade alert, I said buy those, put some of your money into those securities during the first 5 minutes of trading on Monday, December 12th. But from the way that they've traded those securities in the past few days, I don't think it's too late at all if you haven't already bought those securities to go ahead and do so. It looks like, I think that's enough to say about that. I don't think it's too late to put some of your money into those securities. I think, in my opinion, my research and analysis suggests that the oil and gas ETNs that I recommended, symbol AMJ and MLPI, now, I expect those securities from a price perspective to probably rise to around $40 a share within the next 6 months. I mean, let me take a quick look at some notes. And let me also pull out something that you can't see, but I'm going to take a look at while I'm doing this video. There's really no reason for me to stop speaking and Let me just pull up a few of these. One moment, please. Watch this. Well, when I'm doing these videos, I get nervous and okay, and then unfortunately I'm possibly wasting your time. What I'm pulling up is just some charts of the JP Morgan Alerium MLP Index ETN, symbol AMJ, as well as the UBS E-Trax Alerium MLP Infrastructure ETN. And knowing, diving deeply into these ETNs, that is, reviewing all of their individual holdings, my opinion, and also being well aware of supply and demand statistics for crude oil, as well as reviewing about 150 economic indicators every month from around the globe, my opinion is I think there's a good chance, I wouldn't be surprised at all if this JP Morgan Alerium MLP Index ETN, symbol is AMJ, I wouldn't be surprised in the least for it to rise to $40 a share by mid 2017, and for MLPI, the UPS MLP Infrastructure ETN, to rise also really close to $40 a share. So I think there's a very good chance we're going to get some very substantial price appreciation in both of those ETNs, and all along getting some really good dividend yields. I mean, those securities were when I recommended them this past Monday, I've recommended them in the past. They're paying well over 5% annualized dividend yield. So it's a good way to get some both growth and income for those of you that are looking for growth and income. And that's why I recommended them for those of you that follow our growth and income model portfolio, as well as those of you that are just really looking for reliable regular income and are not concerned as much about growth. Is the reason that I recommended them for our fixed income model portfolio. So I feel very good about both of those securities. And now, those of you that also do some speculative transactions in the market and follow our speculative portfolio holdings, this ProShares Ultra Bloomberg Crude Oil ETF, symbol UCO, I wouldn't be surprised if we were to make anywhere from 50% or even 100% return on that security over the next 12 months. I don't expect them to go straight up, but I like what I see in the securities. And as far as the medical device ETF that I recommended, the iShares Dow Jones U.S. Medical Devices Index ETF, I think we're going to get some good gains out of that too during over the coming months and really throughout the year. I expect that to just slowly trend higher throughout the year 2017. Okay, we don't want to get too detailed oriented here. I think provide a lot of details. I know I do, important details in my weekly written commentary. So what I want to do here, I'm going to take about another 5 to 7 minutes. And that's really all. There's no reason to go any longer than that. And as I often say, what we strive to do in these weekly internet TV shows is to tell you everything that you need to know, but nothing more. And that is, and therefore, I'm not going to go off on some unnecessary tangent talking about a lot of things that I could talk about that aren't important. I'm going to focus on what my research and experience suggests to me are important topics. So, a topic that's very important right now, of course, is interest rates. Where are interest rates headed? And of course, the media, they're just obsessed with what the Federal Reserve does regarding interest rates. And for some reason, they seem to always get, in my opinion, the wrong people on their shows talking about interest rates. I mean, we've had Federal Reserve presidents for at least 2 years, really 2.5 years, tell us that they think that interest rates should be raised. And fortunately, the Federal Reserve Federal Open Market Committee, headed by Janet Yellen, except for one time during the past 12 months, held off on raising its target range for the Fed funds rate, because the Fed, was seeing the same thing and researching the same thing that I research, and that is, over the past year and a half, and really going back longer than that, we've had very sluggish economic growth here in the United States as well as in most other regions of the world. And the indicators that I follow on a regular basis had continued up until really just about a month ago to suggest that we're going to continue to see slow growth. But now everything's changing. Everything has changed substantially in just the past month. And some of this is due to the election of Donald Trump. But it's not just that, but that does have a lot to do with what I see going forward. And what I see going forward is huge. I mean, as I said, I think in last week's video, I'm now 100% confident, 100%. There's no doubt in my mind whatsoever that we're going to see the pace of economic growth in the United States increase substantially during the year ahead and over the really next 12 to 18 months and possibly even 2 years. And if that occurs, well, of course, the Federal Reserve is going to raise its target range for the Fed funds rate. But who really cares about the Fed? It just never ceases to amaze me. It's like, what's the Fed going to do? Who cares what the Fed is going to do? And the reason I say that is we've already seen other interest rates that the Federal Reserve does not control already move pretty substantially higher over the past 4 to 6 weeks. And why? Because people that invest in bonds are seeing the same things that I'm seeing. And they're expecting the same thing that I'm seeing, and that is that the pace of economic growth is likely to increase substantially over the next 12 to 18 months. So, of course, we're going to see interest rates move higher. And the Fed's, with 100% confidence, on Wednesday of this week, tomorrow, Wednesday, December 14, is going to raise its target range for the Fed funds rate, in my opinion, up to 0.75%, 0.75%. But that's just an overnight lending rate that banks borrow from each other. It's an important interest rate. It's still a very important rate. But, we need to look at interest rates overall. And as I discussed a few weeks ago in a really long video where I went over a lot of charts and might have bored some of you. In fact, I'm sure I bored some of you. Maybe some of you probably don't want to see all of that type of information, but others of you do like to see it. And that is, I'm also convinced that we're going to have no problematic increases in interest rates. And the reason what I mean by problematic is interest rates will be raised to a level that's going to greatly constrain and curtail economic growth. And the reason I say that is the numerous economic statistics that I monitor on a regular basis indicate very, very strongly that we're not going to have any substantial increases in inflation rates. We're going to have inflation pick up some. Of course we are, because demand's going to increase, but not in any problematic way. So as I went over in that video, historically, to no surprise of mine, when inflation rates increase modestly and not too rapidly, and interest rates increase modestly and not too rapidly, well, that's not a bad thing. That's not going to hurt the economy, and that's not going to hurt stock prices either. Now, some of you might be thinking that, well, the value of any given company's earnings is the current value of expected future increases in earnings is discounted by using an interest rate. And if interest rates rise, that means the present value of those expected future earnings would therefore decline. And you can make an argument, therefore, that, well, if interest rates do continue to go up, that means stock prices should be held in check or come down. But I would argue that even though that's true, that my opinion is that the rate of growth that we're going to have in the economy and the rate of increases that we're going to see in corporate earnings over the next 12 to 18 months is going to more than compensate for any negative effects that we might that we will see by increases in interest rates. So I don't want to get too complicated in here and turn this into a college classroom video. Some of you know what I'm talking about. Some of you don't, but hopefully you generally understand what I'm trying to voice here. So I'm going to look at my notes one more time, make sure I didn't miss anything and what I wanted to talk about today. Interest rates, inflation, economic growth, profits. I think that's it. So yeah, we're going to see a rate hike tomorrow, 100% certainty. 0.75% is what, my opinion, is what the Fed's going to raise the target lending rate. But market participants, I think, are already pricing this in to their expectations, and that's why we've seen the market indices tend to continue to move higher. Now, yeah, there is one other thing that I want to say. Fortunately, now over the past couple of days, we have seen these infrastructure stocks that I've written about and discussed previously, as well as some of the major money center banks, such as Bank of America and JP Morgan, move a bit lower over the past 2 to 3 days. And I think we're going to continue to see them move lower. Not substantially lower, but lower. And more, so I'm monitoring those stocks very, very closely. And when they pull back to areas that I think the valuations make sense, and the pullbacks look like they're beginning to end, and it looks like new investors and speculators will come into the stocks. Well, I'll be recommending you to allocate some of your money to those infrastructure stocks and commercial bank stocks, as well as about 20 to 25 small cap growth stocks that I'm continuing to monitor. But I just, the price, I didn't like the levels at which they're trading at. I always want to be careful here. I'm not worried about anything, but I want to manage risk as much as I want to go after making some big returns. And I'm totally confident that over the next 12 to 18 months, there's going to be plenty of opportunities presented to go into and to buy numerous stocks and equity ETFs and exchange traded notes, ETNs, as well as commodity ETFs and ETNs. So there's just no reason to rush in here. We're going to buy at what appears to be the right time. So that's probably about 15 to 20 minutes. I'm sure that's probably all that you want to hear from me. But I thank you for watching and listening. I hope you got something out of this week's weekly Market Insights show. And I'll speak with you again probably this coming Saturday. I'll go ahead and record another video either Friday or Saturday of this week. Thank you for listening and watching. I'll speak with you again soon.